If your mortgage deal ends in the next 12 months, this is probably not the remortgaging cycle you think it is, not because rates are suddenly spiking, and not because you've done anything wrong, but because we're moving into a period where a lot of fixed rate deals are ending at roughly the same time, and lenders are looking at risk very differently than they did before. This isn't a video about the basics of remortgaging. Most people already know how that works. This is about why 2026 is a different beast, and what that actually means if you've got a mortgage. I'm Georgia. Welcome back to Property Bee. Just quickly, I'm not a financial advisor, and this isn't personal financial advice. This is about understanding how the market's behaving right now so you can ask better questions when the time comes. And if you've got a mortgage, or you know someone who does, this is one of those videos that's worth watching properly, and probably worth sharing as well. Over the last few months, lenders, brokers, and the Bank of England have all been pointing to the same thing. A large wave of fixed-rate mortgage deals is ending now, and it builds pace through the rest of this year and into next. Most of those deals were locked in when interest rates were far lower than they are today. Even though rates have eased slightly, the environment people are remortgaging into is still fundamentally different from the one they borrowed in. So, yes, millions of households are resetting their mortgages. That's not a future problem, it's already underway. What's less obvious is why the outcomes people get now don't line up with what they'd have expected a few years ago. Here's the part that really matters. This remortgage cycle isn't just about interest rates, it's about how risk is being priced. When many of these mortgages were first taken out, lenders were operating in a very different world. Low inflation, stable rates, and fairly predictable assumptions about income and affordability. That world has gone. Over the last few months, lenders have been openly talking about tougher stress testing, tighter affordability checks, and much closer attention to loan-to-value. Not because they want to slow the market down, but because volatility has changed how risk is viewed. So remortgaging has quietly shifted from being a price exercise to a risk assessment exercise, and that's a meaningful change. This is where people tend to stumble. A lot of homeowners still approach remortgaging as if it's just about shopping around for the cheapest rate. In reality, outcomes now depend much more on how a lender views you at the exact moment you apply. Small things matter more than they used to. A valuation that comes in a bit lower than expected, a loan to value that nudges you into a different bracket, a change in income structure, or simply bad timing when lenders are busy. And if your deal ends before you've secured a new one, you're usually moved onto your lender's standard variable rate. SVRs don't grab headlines, but they're still significantly higher than most fixed deals. None of this is dramatic, but it's exactly how people drift into worse outcomes without realizing what's happening. Zooming out slightly, this remortgaging wave doesn't just affect individual households. When large numbers of people adjust to higher monthly payments, even gradually, it changes behavior. It affects spending, it affects confidence, and it affects how willing people are to move, upgrade, or take on more borrowing. That doesn't automatically mean falling house prices, but it does change how the UK housing market behaves at the edges, and that's usually where bigger shifts start to show up. So, if your mortgage deal is ending soon, this isn't about rushing into decisions. It's more about asking yourself a few basic questions before you get anywhere near an application. Do you actually know when your fixed rate ends? Not roughly, but the exact date? Have you checked where your loan to value sits now, not where it was last time? If your lender revalued your home today, would that number surprise you? Do you have your income records and documents to hand in case someone asks for them? And have you spoken to someone independent, just to understand how lenders are currently looking at risk? They're not things you need answers to today. They're just the kind of questions that help you go into the process prepared rather than reactive when you do start shopping around. So if you take anything away from this video, it's that preparation pays off. Especially right now, we're all feeling the cost of living pressures in one way or another. Bills stacking up, prices creeping higher, and that low-level feeling of overwhelm that never quite goes away. A mortgage is one of the biggest and most expensive financial commitments most people will ever have. And when something that big is coming up for renewal, taking a bit of time early really does matter. Even just 15 or 20 minutes here and there, once you know your deal's coming to an end, can make a meaningful difference. It won't remove all the uncertainty, but it can put you in a far better position. And in a market like this, that kind of preparation can potentially save you hundreds, sometimes thousands, over the course of a year. If this has helped you understand what's actually changed, subscribing helps. This is exactly the sort of thing we focus on here. And if you know someone with a fixed rate coming to an end soon, this is one of those videos that's genuinely worth passing on. I've been your host, Georgia. Thanks for watching, and I'll see you in the next one.